Diversification is an investment strategy that involves spreading investment capital across different assets, asset classes, sectors, industries, regions, or investment styles to reduce risk and enhance risk-adjusted returns. The primary goal of diversification is to minimize the impact of individual asset volatility or adverse market movements on the overall investment portfolio by creating a balanced mix of investments with uncorrelated or negatively correlated returns. Now, let's delve a bit deeper into how diversification works. The principle of diversification is quite straightforward. It's based on the idea that combining assets with different risk-return profiles can reduce the overall volatility and potential losses of an investment portfolio while maintaining or improving its expected return. By investing in a variety of assets that react differently to changing market conditions, diversification seeks to offset losses in one asset or sector with gains in another, effectively smoothing out portfolio returns over time. Let's explore the different types of diversification. First, there's asset class diversification, which involves allocating capital across various asset classes like stocks, bonds, cash, real estate, commodities, and alternative investments to achieve a balanced risk-return profile and capture opportunities across different market environments. Next, we have sector and industry diversification. This strategy spreads investments across different sectors and industries within the economy to reduce exposure to sector-specific risks, such as regulatory changes, technological disruptions, or business cycles. Then, there's geographic diversification, which includes investing in assets located in different geographic regions or countries to mitigate country-specific risks, including political instability, currency fluctuations, and economic downturns. Finally, we have investment-style diversification. This approach diversifies across different investment styles such as growth, value, income, or momentum investing to capture opportunities arising from varying market conditions and investor preferences. The benefits of diversification are numerous. Firstly, it helps reduce the overall risk of an investment portfolio by spreading exposure to individual asset-specific risks and market fluctuations, thereby minimizing the impact of adverse events on portfolio performance. Secondly, by combining assets with uncorrelated or negatively correlated returns, diversification can improve the risk-adjusted returns of a portfolio, potentially increasing the return per unit of risk over the long term. Moreover, diversification can smooth out portfolio volatility and reduce the frequency and severity of fluctuations in investment returns, providing investors with a more stable and predictable investment experience. Lastly, it can help investors achieve more consistent and predictable investment performance over time, as losses in one asset or sector are offset by gains in others, leading to more stable and sustainable long-term outcomes. However, there are challenges and considerations to keep in mind. Over-diversification or diversification can dilute the potential returns of an investment portfolio by spreading capital too thinly across too many assets, leading to suboptimal performance and increased complexity. Additionally, diversification may not always provide effective risk reduction if assets are highly correlated during periods of systemic shocks or market downturns, as evidenced by the global financial crisis in 2008. Effective diversification also requires thoughtful asset allocation decisions based on investor risk tolerance, investment objectives, time horizon, and market conditions to achieve desired risk-return outcomes. Furthermore, regular portfolio rebalancing is essential to maintain the desired asset allocation and risk profile of an investment portfolio, as changes in market conditions or asset valuations may alter the original diversification strategy over time. Implementing diversification can be approached in several ways. Investing in mutual funds or exchange-traded funds, ETFs, that offer diversified exposure to multiple assets, sectors, or regions can provide convenient and cost-effective diversification for individual investors. Asset allocation funds, such as target date funds or balanced funds, automatically diversify investments across different asset classes based on predefined risk profiles and investment objectives. Additionally, institutional investors, wealth managers, and financial advisors can design customized investment portfolios tailored to individual client needs, incorporating diversified strategies across asset classes, sectors, and geographic regions. In summary, diversification is a fundamental investment strategy that aims to reduce risk and enhance risk-adjusted returns by spreading investment capital across different assets, sectors, regions, or investment styles. While diversification does not guarantee profits or eliminate all investment risks, it can help investors manage portfolio volatility, achieve more consistent performance, and navigate through market uncertainties and fluctuations over the long term.